In this video, I'm going to review Unity's Q2 earnings, Q2 2024. The earnings came out on August 8th, and so let's dive in. So I'm going to just basically divide it very simply into things that I liked in the earnings release and things I did not like. So let's go through the things that I liked one by one. Firstly, they did deliver on the top line. They did deliver revenue. I think they promised 420 to 425 million, and then they delivered 426 million, which is basically above the higher end. The overall revenue is still down year on year, but basically that's because they are pruning out non-strategic parts of their product portfolio. So the strategic portfolio still grew. And their strategic portfolio, which is basically made up of two segments, as I discussed in episode 1, create segment and grow segment. So create segment was basically up 4% year on year, and if you within the create segment, if you look at subscriptions business, which is basically the subscriptions to the Unity editor that they sell, that was up 14%. I think subscription business is actually more important. In the last quarter, strangely, they did not call out like what was the growth in subscriptions business versus their professional services business, which is kind of a lumpy one-off business, like services that they do for their clients. In the last quarter, they did not call that out, but in this quarter, they called it out, and I hope they keep calling it out in the future quarters. But yeah, so the subscription growth was 14%. And the professional services business and the strategic partnerships and professional services, that's the other part of the business which is more lumpy, that I think did not do so well. So that's why the overall growth was just 4%, but the core subscriptions went up 14%. There's also a very good beat on the bottom line, which would make, I think, shareholders happy. So they promised adjusted EBITDA of 75 to 80 million, but they delivered 113 million. And there are many ways of looking at margins, but I think across all the way that you look at margins, I think they delivered well. The gross margin was 76%, which is on the higher end of several previous quarters. So that's basically one of the good quarters in terms of margin. Uh, on the gross margin and operating loss, they're still, on the operation side, if you come down from the P&L, from the gross margin line, they're still operating at a loss. But if you compare it to the last year, they closed out this quarter at minus 29% versus minus 36% in the last Q2 2023, basically 1 year ago. So their overall operating loss is narrowing. That's what at least it looks like in this quarter. And they did generate positive free cash flow of $80 million. Within the create segment, so they sell to gamers and they sell to other industries. I think I mentioned the last video, basically simulation, training, and product visualization. So they gave some examples in their shareholder letter where they're selling into auto and industrials. Basically that part of businesses, which basically diversifies their revenue, and they're growing on a small base, but they grew their industry revenue by 59%, which is quite encouraging, and now it makes up 18% of their create business, which I think this is a sticky part of the business. This is a part of the business which has high margins because their industry tier of Unity Editor is basically, I think, priced at almost double or basically substantially higher than their Unity Pro license, which they sell to gaming industry, right? So it's substantially priced at a premium, so it's definitely higher margin, and now it's making up higher and higher percentage of their create revenue, which is encouraging to see. So this was basically 18% of the revenue this quarter and 12% in the last quarter. They also lowered their guidance of like how much dilution will they exit this year with. I think earlier it was more than 3%, and now they've brought it down to less than 2%. I think clearly they saw negative kind of market reaction to their last earnings, where their CFO could not explain why did the dilution happen, or basically what was the increased share count about. And they could clearly, I think, see that people are, or investors are, kind of worried about the amount of dilution that they are causing, with their stock-based compensation. So they have specifically called out that now we expect lower dilution, which is a good thing, basically, that management is addressing the shareholder concerns, and they are specifically calling out that we are, lowering our outlook for dilution. They made some strong hires for their growth side of the business. So the growth side of the business is actually struggling rapidly. App11, which is their competitors, is taking market share from them. So they're making some key hires. Basically, they're hiring the founder of Max, which is basically the ad mediation platform of AppLovin today, which they acquired, I think, a few years ago. So they're hiring the founder of Max, basically the person who started that, and then another, I think, executive from the ad tech space. So they're making some key hires within the Grow business to kind of strengthen the talent within their team, and that is, I think, also a positive. It shows that they want to compete aggressively in that space, and they want to win back market share. So the founder of Max and Mopub, which is a key hire, and another ad executive. So these are a couple of hires that they've made. And then the CEO talked a lot about the turnaround culture. I think overall, if you look at the shareholder letter, the um, overall tone was of focus. It was basically centered around that we want to kind of execute on the product side, and which sounded positive. And now basically we have to look how do they execute, but they definitely kind of set the tone that some of the drawbacks that we had in our culture, some of the shortcomings of our culture in the past, we realize them, and we now want to fix them. He did not specifically say that, I mean, our culture was bad previously, but he definitely said that this is kind of the new tone that we want to set in terms of execution and accountability, which was good to hear. And now we need to see how do they do that. And also, basically, he reaffirmed that they want to basically get to the rule of 40, which is basically the sum of top line growth and operating margin, the sum of those two numbers coming out to 40. So that can be 20% revenue growth with a 20% margin, or 30% revenue growth with a 10% margin. So he affirmed that yes, we want to get there. Obviously they did not give any timeline how will we get there, but that is a good model to think about the business. One of the analysts, when he specifically asked this on the call. So these were all some of the good things. Obviously, we need to see how does the new CEO and new management execute, but the initial signs look positive. They are attentive to the shareholder concerns. They are working on profitability, and they are working on fixing their culture, which I think kind of deteriorated under the previous CEO, when there was the whole Unity pricing fiasco, and then just bossed up releases of the core engine, stuff like that. So it looks like they are intent on fixing some of these problems. Another thing to call out, so they call out number of customers contributing more than 100K revenue trailing 12 months. So this is, I compiled the list over the past several quarters of what they reported. And so you can see that since Q2 last year, this number has actually been decreasing, quarter after quarter sequentially, went to 1304. And then this quarter there was an uptick. Now they have reported 1254 customers. So after four consecutive quarters of decline, there is this kind of increase, which is encouraging. But there was kind of some confusion which left me scratching my head. So in their filings, they reported that we had 1254 customers at the end of June, like in the trailing 12 months. These 1254 customers contributed more than 100K, and then in the last year it was 1227. But I went back to their filing for Q2 2023, and there, this is that filing, and they had reported 1330 customers in the trailing 12 months as of June 30, 2023, right? And then here they are reporting 1227. I'm not really sure what's happening. Maybe there is some confusion, or maybe I'm misunderstanding something. You can let me know. But so I've taken the figures that from the previous filing. So it looks like it was declining, and this quarter was an uptick. So these are some of the things that you would like from their earnings release. Now, moving on to things that you would not like probably. So their net dollar-based retention rate dipped to less than 100%. So what this basically means is that 1 year ago, some customers, cumulatively, let's say, contributed, a certain set of customers contributed $100 to their top line, and now 1 year later, the same set of customers are now actually spending less with them. 1 year later, so the same set of customers, maybe some of them just right away outright churned away, like they went away. Some others cut down spending, but their net dollar-based retention rate is now under 100, which is I mean, it's a very important indicator to say, are you able to kind of add more value to your existing customers? Because the cost of acquiring new customers is much higher than, serving your existing customers and trying to upsell them to them and trying to get more revenue out of them and strengthen your relationship with them. You don't incur the cost of extra acquisition cost of having kind of acquiring new customers. So generally would like to see this somewhere in the range of 110, 120. Those are good numbers. So definitely this is the worst quarter in terms of like what they have previously reported. So that's an area of concern. And then according to their filing, this was mostly happening because of their grow business. So as I said, they're losing share in the grow business, so people are kind of cutting back spending on Unity ads, and they're moving their budgets apparently to AppLovin. I think that's and they basically call out aggressive competitive environment, but that's what they basically mean, that they're losing share to AppLovin. What else? So grow business, I think, declined 9% year on year. This is the second segment of their business apart from create. It increased 1% sequentially, but the bottom line is really that, this increase could be due to some sort of seasonality, but the bottom line is really that they're actually losing market share to their competitor AppLovin, which grew 44%. They reported earnings just one day prior to Unity, and they increased their top line by 44% in the most recent quarter year on year. So AppLovin is definitely growing at Unity's expense, and they need to kind of put a stop to this route to their grow business and try to kind of win back some of the market share, which is, I think, one of the key risks and observables in this business. They've also reduced their full year outlook, although I think market had largely priced that in even during their last, based on their last earnings call, given how much the stock declined. So they've kind of lowered their full year outlook, I think, to 1685 million or 1.685 billion for the full year, for 2024. So at this time, they're trading at roughly 4.5 times EV to sales. Like if you consider their valuation, and their EBIT margin is negative 40%. So it's not. I mean, although it has declined so much, it's. It's not super cheap even at this point. I have an existing small position in Unity, and I'm going to. I still like the business. I think I discussed some of the reasons in the last video of some of the opportunities that they have in front of them. But yeah, so this is where they're roughly trading. And so, what are some of the things that we should watch out for? I think so there are a few things. First is the Unity 6 launch, which is going to happen in fall this year, which is basically something. These are the things they need to execute on really well. So, which is basically the next leg of growth. There are a lot of good, or basically promised, product changes in Unity 6, and from what I have read, it contains a lot of performance improvements, stability improvements, ability to render large scenes, integration with the cloud. So a lot of hopes are kind of resting on Unity 6 and how well do they deliver on that. So that's one observable. And the second is obviously the grow business, which I've repeatedly called out, which is basically one of the main risks. If they are able to kind of pivot grow business to growth again, which is kind of ironic, the grow business is declining, but if they are able to pivot that to growth again, or stem the market share loss and then kind of get back to growth again, I think Unity can be in a very good place, because the ad mediation business is also, once you basically hit those efficiency ratios in terms of ad spend, it is an incrementally very profitable business, because an incremental amount of traffic or the ads that you serve, your fixed costs are pretty much fixed, right? And the variable costs, they scale with the revenue. So almost, a large amount of additional revenue flows through your bottom line, which is also something that you can see in AppLovin. So it's a margin accretive business over time, once you keep scaling it up. And so it's if they're able to do that, I think it will be a great thing for their business. It will give investors a lot of boost to the confidence. Another thing to look at is, so they have 1.3 billion of cash in their balance sheet, and this is basically their commitments over the remainder of 2024 or the next 3 years. So you can say this year is not really a problem, but in 2025, 2026, they basically owe almost 1.8 billion dollars out, in their operating leases, purchase commitments, and the loan outstanding debt that they have. So over the, I think, those 2 years, they need to pay out this amount of money, which I think they can manage if they, if they're generating some amount of free cash flow, and then they have some cash on their balance sheet, and there is no, let's say, uh, economy kind of downturn, and they keep generating that free cash flow. They should be able to serve this part, and then they have another billion coming up over the, next 2 years. And so it will be, it is something that we will need to observe, obviously. So this debt, which is basically their 2026 and 2027 notes, is actually quite, I mean, they raised at very good prices, I think 2% and 0%. So these are convertible notes. If they are not able to serve it with the cash flow that they have and the cash that they have on their balance sheet, then they will have to, I guess, dilute even more. Probably they'll have to then kind of raise more equity capital and then try to serve that debt, because these convertible notes are already at such good prices, I think 0%, 2%, that if they I mean, they can potentially refinance it, because I think the interest rates will drop by then, at least by some amount. Maybe they will come back to 4%. I mean, I'm not sure about the interest rate curve, but they should be lower than where they are right now by this time in the next year or so. So they can also refinance this debt, but they will definitely have to refinance it at a higher interest or coupon rate than they have right now. So then it will increase their interest expense. So obviously a downturn is good for no business, but yeah, so these are some of the contingencies that, or commitments that they have to kind of pay back. And the good thing about paying this debt back is it will also kind of reduce their diluted share count, so improve the valuations basically. And yeah, so that's about it. Thank you so much, and let me know what do you think about the earnings release, if you have any thoughts or anything that I've missed. And I'll see you soon with something interesting again. Bye bye.